Interest rates are dropping quickly and many homeowners are wondering, should I refinance my home loan now or is this just a temporary change? So on the surface, right, it seems simple, lower interest rates means smaller monthly payments, right? But before you rush in, there's more to think about. Could refinancing save you thousands? Or are there hidden costs and details you need to understand first? After months of dealing with high borrowing costs, we are finally seeing a light at the end of the tunnel for high interest rates. So on September 18, the US Federal Reserve made a big move, cutting interest rates by 0.5%, bringing them down to 4.75 minus 5%. And guess what? This could be just the start. Fed has hinted at even more cuts, another 0.5% by the end of 2024, a full 1% in 2025, and rates might drop to around maybe 2.75 to 3% by 2026. So what does this mean for you? Lower interest rates make borrowing cheaper, whether it's for personal loans, business investments, or even mortgages, right? So this could lead to more spending, stronger investments, and a boost in the economy. But don't get too comfortable. Alright, so this is a warning for every one of you. The Fed is still keeping an eye on inflation and wants to make sure that the economy stays stable. So in Singapore, it's a little bit different. Alright, here we focus this on the exchange rate, not just about interest rates. However, since the US economy has a big influence on global markets, changes in US rates will likely affect borrowing costs and our financial decisions in Singapore as well. So what do you think of the current rate cut? Share your thoughts below. So to help you navigate these changes, we've broken this down into 3 key factors on the REI method, a proven strategy to help you succeed in any Singapore market. Number 1, cheaper loans and mortgages and how lower rates impact our borrowing. Number 2, investments and property prices, what to expect in the market. And number 3, currency and foreign investments, how global changes may affect your finances. Hey, this is Coach Edmund, your Singapore Real Estate Insider. So before we dive in, don't forget to hit the subscribe button and turn on the bell icon to get simple, clear property tips every single week. Now let's talk about interest rates. The good news, they're coming down, and this is great for homeowners because it means what? Borrowing money, right? Like taking a home loan, it actually gets cheaper now. So lower rates means smaller monthly payments, which is a relief for anyone looking to buy a property or to refinance their loan. So why are Singapore rates dropping? It's because they are closely tied to the US. When the US Federal Reserve changes its rates, Singapore tends to follow as well. So when rates in the US go down, we will benefit here too. Lower interest rates can make buying a home much more affordable, and many people are jumping at the chance to lock in a good deal. It seems like the perfect time to buy, right? Well, not so fast. Okay, interest rates are important, but they are not the only thing to think about when buying a property. Some people might say, hey, why not wait for the rates to drop even more? That's tempting, right? But there's always a catch. If you focus only on rates, you might miss other opportunities in the market as well. So what else should you be looking at when making property decisions? Let's break it down together. Number 1, property prices and market trends. Even if interest rates go down, property prices could go up again. When borrowing money becomes cheaper, more people will want to buy houses, right? Which increases the demand. This higher demand could push property prices higher. So while you might save money on interest, you could actually end up paying more for the property itself. Number 2, supply and demand shifts. Singapore's property market works in cycles. When interest rates go down, more people start buying properties, which means there's more competition. This can make it harder to find a good deal out there. If you wait too long, you might end up competing with a lot of other buyers for the same property. And number 3, your financial readiness. Now remember, buying a home isn't only about the interest rates. You could also think about your own finances. Can you afford a down payment? Do you have enough savings for emergencies? It's better to buy a home when you're financially ready, not just when the interest rates are low. Curious to learn more? Sign up for our live masterclass online and drop masterclass in the comments below. At first, it might sound strange to say higher interest rates could lead to higher profits. After all, doesn't a high interest rate means you pay more on your mortgage? And wouldn't that scare off buyers, causing property prices to drop as well? So here's the surprising part. The proof is in the results. If you look back, interest rates have gone up and down over the years. For example, in the second quarter of 2019, rates were a bit higher than they were after that. Then, they started to fall steadily. So what do you think happened to property prices as interest rates dropped? Many people think that higher interest rates makes it harder to buy homes. So properties bought when rates are high will be less profitable compared to those bought when rates are low. But that's not always the case. Actually, when interest rates go down, property prices tend to rise because more people rush to buy, thinking it's a great time to get a good deal. This increase in demand pushes prices higher than you expect. For example, when interest rates were very low, the prices of new homes jumped by 54%. Let's take a closer look at some of the real-world examples, right? Whistler Grand, a 3-bedroom unit, is a prime illustration of how timing and market cycles affect property value. Now let's break it down. Q1 of 2019 to Q3 of 2020, during these times, interest rates, the cost of borrowing money started to drop. This makes it cheaper for people to take out loans for buying property. So as a result, the price of the 3-bedroom unit went up by almost 140,000. Buyers jumped in early to take advantage of lower borrowing costs. Q3 of 2020 to Q2 of 2022. As central banks kept cutting interest rates to keep the economy recover from the pandemic, more people started buying homes, and in this period, the price of the 3-bedroom unit shot up even more by 217,000 thanks to super low mortgage rates and strong demand. So from early 2019 to mid-2022, the total price increase for this unit was almost 360,000. That's a huge jump in just a couple of years. A difference could really change somebody's financial situation if they bought at the right time. The best time to jump into the market is typically when interest rates are just starting to fall. This is because when rates drop, borrowing money becomes cheaper, and property prices may just be relatively stable or haven't fully adjusted yet. And if you wait until rates hit bottom, and when I mean bottom is rock bottom, it might be a little bit too late, as the market could already have picked up, making homes more expensive or even more competitive. So getting in early while rates are starting to come down can give you a better deal in the long run. Now let's take a look at Sterling Residences, a 2-bedroom unit. Between early 2019 and late 2020, the real estate market saw a lot of changes. And with Sterling Residences being a key part of this shift, as interest rates dropped, the price of the 2-bedroom unit increased by 89,000, grabbing the attention for both investors as well as home buyers. And when interest rates fell even more to almost zero, prices shot up another 96,000. So at first, low interest rate made it easier for buyers to borrow money, which seems like a great opportunity, right? Creating a buyer's market with affordable loans. However, this situation didn't last long. The lower rates triggered a rush of people eager to buy before prices went higher. So this sudden demand put pressure on the market and caused prices to rise quickly. What started out as an easy-going market turned into a highly competitive one. Buyers were in a race to grab the few available homes, giving sellers the upper hand and pushing prices even higher. So those who acted quickly were able to secure great financing and saw their property prices increase in value fast. Whereas on the other hand, buyers who waited found themselves facing higher prices and also tougher competition. Let's take a closer look at an interesting situation at Treasures and Tampines. We're going to compare two units that seem pretty simple at first. One is in Stack 10 with a beautiful, peaceful view of the pool. The other is in Stack 11, which faces the bin center. Sounds like an easy choice, right? But there's more to the story. At first, it seems obvious you expect the unit with a view of the pool to cost more, right? Well, so most people would prefer a peaceful view over one of the trash collection areas lah. But here's the surprising part. The unit facing the bins actually sold for 300,000 more than the one by the pool. Crazy, right? You think no one will want to pay extra for that kind of view? Now, this shows that property value isn't just about how nice the view is. There are actually many other factors at play. In real estate, timing is just as important, if not more important, than the property itself. For example, even a unit that looks less desirable, like one facing a garbage bin, can increase in value during times when demand is high. On the other hand, during slower market periods, even fancy high-end properties might not sell quickly or may even lose its value. So this shows that the market's behavior, not just the features of a property, can determine its price. So just because a property doesn't seem like a great deal on the surface, doesn't mean it won't be a smart investment if the timing is right. The key is that property investment isn't always logical. It's about knowing the right moment to buy or to sell. Also, the examples show how interest rates impact the market. If you wait for interest rates to be at their lowest, you might end up competing with a lot of buyers, which could push prices up. On the other hand, if you bought earlier when rates were still falling, you might have gotten a better deal before the crowd arrived. Now, the lesson here is that patience can help, but waiting too long can also hurt you. It's about understanding how changes in the market, like interest rates, affected prices, timing of purchase or sale, can actually make a lot of difference. So understanding how interest rates influence property prices isn't just about looking at percentages or monthly payments. It's also about timing your entry carefully and recognizing how the market dynamics shift in response to these changes. So with both fixed and floating rate packages softening, now might be a perfect time to explore your options. Whether you value the stability of a fixed rate or want to ride the potential downtrend with a floating rate, the market is primed for opportunity. So keep an eye on these trends. With rate cuts expected to continue, this window for unlocking its favorable terms is already opening. For a personalized assessment tailored specifically to your needs, feel free to pause the video and scan the QR code on your screen. So by reaching out, you'll receive expert guidance like us to confidently help you to navigate the complexity of your property decision with a peace of mind. So if you find today's analysis helpful, please support the channel by liking the video, subscribe, and hit the notification bell so you don't miss any future updates and in-depth property assessment into the Singapore property market. I'll see you real soon.